Before we get started, I want to let you know that I have a second channel that I started recently called Bloom, where I talk about interesting stuff such as will the economy collapse because of this virus, when exactly this pandemic is going to end, why the stock market is rising when the country is in a recession, or even things such as what are the Tesla's 5 next big products, some fascinating facts about World War II, and a lot of other interesting stuff. There are already a lot of videos you can watch right now, so head to the channel by clicking in the link in the description and subscribe. You probably heard that the best investing strategy is just to throw your money into an index fund and let it grow until you retire. And with an average growth of 8 or 10% annually, with the power of compounding, you will be doing great by the time you retire. But no one really talks about how to do that, how to invest in the S&P 500, what stocks you have to buy to do that. So here in this video, we will answer that question. But before we figure out how to invest in Vanguard index funds or the S&P 500, we have to understand a few key concepts. What is an ETF? How do mutual funds work? And what kind of ETFs you have to buy to get an average rate of 8% annually? An ETF, or an exchange-traded fund, is a security that includes within itself multiple other securities such as stocks, bonds, real estate. It's basically a financial management company that takes investors' money and invests them in certain types of assets. But at the same time, their stocks are traded in the stock market like any other publicly traded company. It's a great way to diversify your investment portfolio. ETFs usually track a particular index. The most famous ETF type you probably heard about is the one that tracks S&P 500. S&P 500 is a stock market index that measures the stock performance of 500 large companies listed on the stock exchange in the United States. There are around 3,700 publicly traded companies in the US alone, so as an investor you have a pretty big choice. However, it's not easy to analyze so many companies and find out what are the best, at the same time the safe investments. That's where S&P 500 comes into the picture. It filters the best and safest stocks out of this basket. There are certain criteria that a company needs to meet in order to join the S&P 500, such as the company should have at least $8.2 billion of market cap. Most of its shares should be in the public's hand. The company should be in the stock market for at least a year, and many other criteria. Even a company like Tesla, with its over $300 billion valuation, couldn't join the index. But that doesn't mean that every company in the index fund is going to do great in the long run. But since they are the largest 500 companies in the country, most of them in the long run are going to grow at different rates. And judging by historical data, since its inception in 1926, it has been growing approximately at 9.8% annually, or 6% after inflation. However, there were several years where the index declined over 30% during crises. The 10 largest S&P 500 companies account for 26% of the index. Companies such as Apple, Microsoft, Berkshire, Alphabet, Johnson & Johnson, and a few others. If you realize that at least half of them are tech companies, so if they suddenly rise for one reason or another, they will have massive influence over the market and drag with them the rest of the market. But on the other side, if they fall, the entire market could be down just because tech companies aren't doing great. A mutual fund is similar in many ways to an ETF, but functions in a slightly different way. Instead of passively investing in a certain index or an industry, managers at mutual funds strive to beat the market by at least a small margin. So before picking up a company, they would analyze their financial statements and try to invest only in companies they believe would do the best. Investing in a mutual fund is like hiring a bunch of financial experts who will choose where to invest your money in. But that doesn't come at a cheap price. Mutual funds usually charge a percentage for their hard work to manage your money, which is typically between 0.5% or 0.75%. Anything higher than that most probably doesn't worth it. 1% might not seem like a lot of money if you're investing $1,000, but if your portfolio is around $1 million, for example, then that's at least a $10,000 difference. If that's the case, why would anyone invest in a mutual fund? Well, you see, when you have a huge portfolio, let's say $100 million, beating the market even by a small margin like 1% is a lot of money, because that will equal to $1 million, enough to provide you with a luxurious life for the entire year. Imagine if they beat the market by 2 or 3%. The difference would be massive. So, the question is, where do you find ETFs or mutual funds to invest in? And that's where Vanguard comes into the picture. The Vanguard Group is a financial management company that has multiple ETFs and mutual funds under their wing, with about $6.2 trillion in global assets under management. They have ETFs that invest in bonds or different industries, or mega caps indexes such as companies that have a market cap of over $200 billion like MGC. You can scroll down through their website and find the right ETF or a mutual fund for you. The famous ETF that invests in the top 500 US companies is VOO, or the S&P 500 ETF. That's currently trading at around $313 at the time of this script. Its assets worth almost $600 billion, with its top 10 investments representing 30% of its assets, since most of them are tech companies such as Facebook, Amazon, Apple, and so on, which also makes it a slightly risky investment in the short run. That's why Vanguard puts it at level 4 risk. Tech companies are quite volatile, which means they quite often either significantly rise, as they are doing now, or dramatically drop. So if you're more of a short-term investor, that's probably not the best option for you. It makes more sense if you're looking for 10 years or more. By the way, it has an expense ratio, but it's really low, 0.03%. That's insignificant. This particular ETF was created back in 2010, and since its inception, it had an average rate of return of 17.7%. That's incredibly high. But you have to take into account that the last 10 years were the longest period of economic expansion in the history of the US, and tech companies that makes up 30% of its portfolio skyrocketed in the last 10 years. That's why it doesn't mean it's going to have the same rate of return for the next 10 years, since if this ETF was created 3 years earlier, back in 2007, numbers would be completely different, because in 2008 we had a financial crisis. The S&P 500 was down by almost 50%, and financial crises happen every now and then. Another ETF worth taking note is VTI, or the Total Stock Market ETF. It's huge, with assets reaching almost $1 trillion, maybe because it was created back in 2001, so it has been around for almost 20 years. That's why it can give us a more accurate rate of return, which has been historically 7.8%. But Vanguard isn't the only financial management service company that provides such services. The market is filled with them. Fidelity Zero Total Market Index Fund is an ETF that's provided by Fidelity Investment that also invests in the S&P 500, or PowerShares Triple Q by Invesco Capital Management. There are just so many of them that we can't cover here in this video. The question that most of you are wondering about is, how can I buy a Vanguard ETF stock? To invest in one of these ETFs, all you need is a broker. If you are in the US, you probably heard about Robinhood, for example. This video is not sponsored by them, but because they are commission-free, it makes it easier for many to start. But they aren't the only one. You can use any other broker. But if you're not in the US, it doesn't matter. You can invest in these ETFs through almost any broker in your country. You just have to find one. If you take a look at the S&P 500 rate of return for the last 90 years, it has been 9.8%. That doesn't mean it's going to be like that forever, but 90 years is a long enough period to assume that it will be around that number for the next few decades or so. If you have a full-time job or a business, it doesn't make sense to you to sit down and analyze stocks every single day and find good investments. You might not even know how to do that. That's what makes ETFs so attractive. It's a convenient way to invest. But before you throw your money into one of these index funds, be sure to research more about them because you are risking your money. Don't base your decision solely on a couple of videos you have watched here on YouTube, but rather understand the market. And most importantly, make sure to give this video a thumbs up if you have enjoyed it and found it helpful. And if you're new around here and want to know more about investing, then make sure to subscribe and turn on your notifications. Thanks for watching, and until next time.